Welcome to this explainer. Today, we're going to take the incredibly complex macroeconomic shifts of a new Federal Reserve framework and translate them into the actual tangible impacts on your stock portfolio and your mortgage. When leadership at the world's most powerful central bank shifts, it doesn't just change the headlines. It literally rewires the entire global economic engine. So we're going to look specifically at the economic mechanisms, the market reactions, and the policy pivots that happen when someone like Kevin Warsh takes the reins as Fed chair. We're going to break down how these institutional changes alter the path of benchmark interest rates and, ultimately, dictate the valuation of the entire stock market.
Okay, let's just dive right into this by asking the billion-dollar question that sits at the very center of your wallet and, honestly, the global economy. What actually happens to your money when the Fed changes its mind? Right? We hear about policy shifts and structural reforms all the time on the news, but the transmission from a boardroom in Washington, D.C. down to your personal bank account or your 401k, well, it can feel like a total black box. Today, we are cracking that box wide open. To make sense of this massive institutional shift, we're going to follow a clear roadmap. We'll hit 1. The Fed's new playbook. 2. Rewiring the economic engine. 3. The 6-step chain reaction. 4. Impact on your wallet. And finally, 5, the AI productivity gamble.
All right, jumping into Section 1, the Fed's new playbook, a leadership shift. Let's see how Kevin Warsh's leadership sets new core objectives for the whole system. Before we get too far into the weeds here, we really have to understand our baseline metric. Because make no mistake, whoever controls this rate controls the cost of capital on the planet. The federal funds rate is simply the overnight borrowing cost for commercial banks. But it acts as the absolute baseline for all consumer and corporate debt. Whether you've got a mega corporation borrowing billions to build a massive new factory, or you're just taking out an auto loan, this rate is the gravity that dictates exactly how expensive that money is going to be. Setting this target rate is the primary lever the chair uses to manage inflation and try to keep prices stable.
Now, it's actually wild to think about this, but a mere 12-member voting body holds the keys to this multi-trillion-dollar economic machine. That's the Federal Open Market Committee, or FOMC. You see, the Fed chair doesn't just act alone like a king. They have to lead this 12-member committee to establish that critical federal funds rate and manage the central bank's massive balance sheet. So to execute any new playbook, the chair first has to build a consensus among these 12 individuals.
Moving right along to Section 2, rewiring the economic engine. Let's look at the actual mechanics of how the Fed swaps out the parts of its economic engine once that consensus is built. This perfectly illustrates the philosophical swap happening at the highest levels. They are discarding static historical models for dynamic, supply-side metrics. Under the old framework, you had these discretionary, forecast-driven models relying on traditional core personal consumption expenditures to gauge inflation, basically looking in the rearview mirror. But the new playbook throws that entirely out the window. Instead, it leans into structural reform. Crucially, it prioritizes artificial intelligence productivity gains, treating them as massive anti-inflationary forces. And it completely changes the inflation gauges. Instead of traditional core measures, it uses what's called trimmed average inflation calculations. Think of it like throwing out the extreme highs and lows, like a sudden energy spike or a temporary tariff, just to find the true underlying trend of what things actually cost. They are essentially putting on a brand new pair of glasses to look at the economy.
So what's the big deal? Well, when the Fed alters rates based on these new metrics, it directly changes one massive variable, the discount rate. This immediately acts as a transmission vector right into the stock market. In finance, investors use the discount rate to value the future earnings of a company. If the Fed lowers the baseline interest rate, the discount rate falls. And, mathematically speaking, a lower discount rate increases the present value of all this future corporate earnings. That right there is what boosts stock prices. It's the direct, mechanical link between central bank policy and corporate valuation.
Which brings us nicely to Section 3, the 6-step chain reaction. Now that the engine is rewired, let's trace exactly how a policy change at the top ripples all the way down.
Let's watch the dominoes fall. This 6-step sequence is exactly how a structural policy pivot turns into a major equity index rally. Step 1. The new leadership initiates a policy shift, prioritizing those supply-side productivity metrics over the old static models. Step 2. Because they are blaming inflation on temporary shocks rather than systemic demand, they feel comfortable stabilizing rates, holding them steady, or even moving them lower. Step 3 happens at the exact same time, balance sheet reduction. The central bank actively sells off assets, like mortgage-backed securities, to pull excess liquidity out of the system. Step 4. The bond market reacts.
The yield curve adjusts to this specific combo of tighter liquidity but lower short-term rates. Step 5. As we just talked about, corporate valuations adjust upward because the cost of capital is lower. And finally, Step 6, the grand finale. Capital moves away from boring fixed income assets and flows directly into equities, driving up major stock indices. Boom. Predictable, mechanical chain reaction. All right, Section 4. Impact on your wallet. It's time to translate all this institutional jargon into the reality of your daily life. How does this actually feel for your loans and your retirement portfolio?
Here's where things get a bit paradoxical. While corporate borrowing costs might plateau or even drop, your mortgage rate will likely stay stubbornly elevated. Why? Well, short-term borrowing costs face less upward pressure. But remember, the Fed is actively draining liquidity from the system, so commercial banks have fewer operational reserves, meaning commercial loans become a lot harder to secure for everyday businesses. And here is the truly painful kicker for homebuyers. Because the Fed is deliberately selling off mortgage-backed securities to shrink its massive balance sheet, it actively raises the yields on housing bonds. So consumer mortgage rates completely decouple from the broader trend and stay high. All the while, the market is rapidly repricing these structural reforms, causing some pretty sharp short-term equity volatility.
Now, this is absolutely crucial. The Fed's new framework directly hands a premium valuation to the tech sector by literally crowning AI as an inflation killer. Think about that. If the Fed officially integrates structural economic shifts like AI into its interest rate calculations, viewing them as a force that increases output without raising prices, they are essentially giving a massive institutional stamp of approval to the tech industry. The central bank is validating their entire business model as structurally vital for price stability. That is huge. And that stamp of approval triggers what we can call the great reallocation. Investors aren't just going to sit around. They are actively ditching traditional defensive positions to chase capital appreciation in these structural growth areas. Because baseline interest rates are stable or lower, those old-school high-yield defensive stocks and bonds, they lose their appeal. Institutional algorithms and human traders quickly adjust their models, pull their capital out of defensive assets, and pour it straight into growth equities, specifically tech and AI. They're just taking advantage of that lower cost of capital and the Fed's newly validated productivity premium. Finally, let's look at Section 5, the AI productivity gamble, because this entire playbook rests on one massive underlying assumption. The dangerous reality here is that banking on unproven structural economic shifts is literally walking a tightrope without a safety net. The central bank is intentionally shrinking a multi-trillion-dollar portfolio of government debt. They are sucking liquidity out of the system while trying to keep rates relatively favorable, all based on a debt, a massive gamble that artificial intelligence will create enough economic productivity to just naturally offset inflation. It's an incredibly high-stakes balancing act between tightening the balance sheet on one side and leaning on a super optimistic, tech-driven forecast on the other.
So, what could go wrong? Well, a few things. First, FOMC dissension. Remember those 12 voting members? The chair is just one vote. If regional Fed presidents reject this whole productivity-driven framework, the policy stalls out. You get conflicting public messages, and that instantly destabilizes the market. Second, stagflationary overwhelm. What if external shocks, like massive geopolitical energy conflicts or crazy import tariffs, drive prices up way faster than AI supply-side growth can push them down? The Fed would be forced to unexpectedly hike interest rates again. And third, a liquidity squeeze. If they sell off that balance sheet too quickly, they could completely starve commercial banks of operational reserves, sparking a rapid, painful sell-off in equities.
To wrap up this explainer, I really want to leave you with this pivotal question. What happens to the entire house of cards if the technology just doesn't deliver on its deflationary promises? If AI doesn't create rapid, measurable increases in economic output, and the Fed has already cut or held rates steady based on that assumption, well, we'd be staring down the barrel of a severe resurgence of structural inflation. The new playbook is absolutely brilliant in its mechanics, for sure, but it relies entirely on a technological revolution that is frankly still proving its worth. So keep a very close eye on those productivity metrics because they aren't just tech news anymore, they are the new foundation of global monetary policy. Thanks so much for joining me on this deep dive.